Financial ratios are mathematical comparisons of financial statement account balances or categories. Most of these ratios result from dividing one account balance or financial measurement by another. If you recall, back in elementary school arithmetic you studied fractions. That's what ratios are. These relationships between the financial statement accounts serve as indicators and help internal company management, owners, and creditors understand how well a business is performing and what areas need improvement. Analyzing ratios and using vertical and horizontal analysis make up what is called financial statement analysis. How are ratios presented mathematically as a percentage, as a decimal number, and as a relationship? How often should these ratios and analyses be calculated? These ratios may be calculated on an annual, quarterly, or monthly basis. Ideally, you should review your ratios on a monthly basis to keep on top of changing trends in your company. If you wait till the end of your year, you've let the barn door open. Doing monthly analyses provides current information so you can identify and correct problems before it's too late. When comparing these ratios, you should compare apples to apples. In other words, compare months to months, quarters to quarters, and years to years. How many ratios are there? While there are many ratios that could be calculated, small business owners and managers only need to be concerned with a small set of ratios in order to identify where improvements may be needed. In general, financial ratios can be broken down into 4 main categories with several specific ratio calculations within each category. The categories are profitability ratios, liquidity ratios, leverage ratios, and activity efficiency ratios.